Hi, all. It's 3:03 here on Monday afternoon. Welcome to our webinar, Restaurant Wage Models, Legal, Financial, HR, and Payroll Considerations. I'm Julie Sproesser. I'm the Interim Executive Director here at the Restaurant Association Metropolitan Washington. Thank you all for joining us today. Just a couple of housekeeping things. We're in webinar mode, which means you can see our speakers here today. They can't see you, but they can see who has signed on in the participants box. You can enter questions you have along the way, and we encourage you to in the Q&A box or the chat box. Che on our team will be monitoring both of those, but we're going to come to questions at the end. So stick with us. We'll save lots of time for questions, and I'm sure you're going to have many of them, but please put them in the chat or Q&A box, and we will definitely call on all questions at the end. To kick us off here, I want to thank our panelists for joining us, Matt Hetrick, president of CPA Eats, Joy Einstein from Shulman Rogers, and Kathy Ogilvie from Payroll Network Inc. These past few years, many restaurants have explored ways to manage compensation. For many of you, this was a temporary move during COVID to shift operations where employees may have worked very different roles. Many operators added service charges as well as many different creative models to help support front and back of house. Here at RAMW, we've heard from so many operators looking for insight on what others are doing. If they have a service charge, how's it going? What's it covering? And how are they communicating it to guests, which can often be, a difficult move. We're seeing a lot of commentary in the media, on social media, about how that's going. If people understand the service charge, there's definitely a lot to consider. On top of it, how that's going to affect your P&L, how it will affect what staff are earning. And we know there's a lot of questions about these. That's why we're here today at your urging to get some of these questions answered by our experts who are in the room. There's also, of course, this issue of Initiative 82 that is before us. We're just a little under, I think we're 14 days now from Election Day, where this ballot initiative to eliminate the tipped credit in DC is on the ballot, as you all know. This is not the first time we've been in this position. We did this with Initiative 77 back in 2018, and we're very much pushing the Vote No to 82 campaign that is in full effect across media platforms. You'll see signs all over town. We're hosting operator meetings and tipped worker meetings every single week to give you the information you need or your teams need. We certainly continue to advocate for your choice as operators and how you compensate your staff, as long as you've met that minimum wage requirement, that there should be options for you on how you do that. But while we fight 82, and as many of you have wanted to explore what a service charge model might look like, we wanted to put this information in your hands. And if 82 voters do pass 82, restaurant operators will have to make some hard decisions about what they do, certainly considering all the things we're going to talk about here today. So with that, I'm going to turn it over to Matt Hetrick of CPA Eats to walk through what some of those scenarios have looked like for his clients, and that could be an option for you as you think about where you might want to go down the road. Matt?
All right. Big thank you to Julie, Che, and the rest of RAMW for inviting myself and Joy and Kathy to host this webinar together. As Julie introduced, obviously, we're looking at some of the alterations we can make to operate restaurants in the post-tipped world, whether that's something that happens legislatively or whether it's something that different operators are exploring on their own, of their own volition, for various different reasons. Doesn't necessarily matter. The challenges I think that we all face are pretty much the same. I see some of our friends and clients here on the list, so hopefully this helps. Also, my firm is Harmony Group with CPA Eats. We focus on hospitality accounting here in DC, as well as major cities all through the East Coast. Next slide, Julie. Okay, so to start off, the next slide after this, to set the baseline for this conversation, what I've given everyone here really quickly is a pair of slides showing the current industry model, both in its typical P&L format, as well as sort of the ghost wages, if you will, that exist inside of our industry, just to make sure that we understand why you have to make a change and can't simply pay people more. I'm going to reference these slides, not necessarily visually, but at least conversationally, as I go through some of the options to adjust. But in the typical model that we have right now, and this is really based on a full service restaurant, Most of you guys might have bars, you might have some of the different iterations of hospitality. So you'll have to translate this to your own numbers. But in the platonic ideal of a sit-down restaurant, for every $100,000 of revenue that you generate, your cost of goods sold might blend to about $27,000, give or take five, one way or another. That's going to leave you a gross profit of about 73 grand. There are other costs that I've aggregated down at the bottom that'll run 27% of your gross revenue. And that's going to be everything from your rent, your utilities, your repairs and maintenance, your marketing costs, your direct operating, your G&A. Each of those things add up to about 27 cents on the dollar that you bring in. And then the bulk of what's left over goes to labor. And in a typical P&L, you're going to see 10% of your sales go to your salaried management team, front of house and back of house together. Your hourly back of house team is going to run about 17%, give or take a couple percentage of your sales. Your front of house on a nominal P&L, this is a very important one, will run at like 5% roughly of your total sales. And then you're going to have your labor burden, which will be taxes, workers' comp, health insurance, those kind of benefits that'll run about 6%. And all of that will add up to, bottom line of roughly 8%, give or take your piece. And we have people who lose 30%. We have people who make 40%, everywhere in between. So these should be taken as sort of, again, like your platonic ideal, the targets you'd be aiming for. This is sort of directed towards full service restaurants where tipping is the norm. And that would be what you see on a regular P&L. Then you have this ghost set of revenue and wages, expenses that don't really show up on that P&L, and that's because tips don't belong to the employer. So your tips don't show up in your gross revenue, nor do they show up in your expenses. But if you were to add those in, you'd have another $20,000 of revenue that came in, and then you would see that extra $20,000 goes out as an expense in the form of tipped wages to your hourly front of house staff. So if you change these things up, really, the industry pays close to 50% of its sales out to its employees in the form of wages, some of which aren't shown on the actual P&L. If we go to the next slide, this is what happens when you switch to a non-tipped minimum wage model, or are forced to, whether it's of your own volition, if you don't make any adjustments. You would have the exact same P&L, right? Except for your hourly front of house, when you switch from $5.35 an hour, which is your credited tip minimum wage in DC right now, to $16.10 as the tipped minimum wage that comes out of your pocket, you're going to have effectively a tripling of your front of house labor cost. And if you do that without any adjustments, what will happen is you're going to drive yourself to an EBITDA level that is automatically a loss. Even the most platonically ideal kind of restaurant would lose money. So when you look at that model and you say, this is the baseline we're starting from, it'd be nice to take people from $5 an hour as their, cost to the company to 16. Without making adjustments, you would go out of business. And everybody who's started to look at those options realizes that very quickly, especially if they're working with someone like us. And then we look at some of the options, and that will be our next slide and the core of these options. So our clients have really honed in on one of 4 different alternative compensation models as they sort of address the post-tipped world. I'm going to go through each one of these for us, talk about some of the pros and cons, talk about implementing them and what the challenges are. Just to lay the groundwork for Joy to talk about the legal implications of each of these things, and then we'll take your questions. The first one, the very simple one, is on my top left option here. That's just simply increasing your prices. The simplest way to deal with an elimination of a tipped minimum wage is to increase your prices to offset the increase of front of house wages. In some ways, this is like the tipped, sort of like the Danny Meyer model in New York City, where you just increase everything and it's all included. In this case, your increase from 535 to 1610 is going to equate to an increase in your cost structure of about 10% of your gross sales. This is what I showed you on that other slide. So the price increase to make up for this wage increase would have to be somewhere between 15 and 20% of your current prices to cover it. It's not going to be a pure just 10% increase, because you would expect to have elasticity of demand as your prices go up. 15 to 20% increase means that your $17 burger is going to go up to 21 or 22 when all is said and done. So it's a pretty big nominal increase in that. This is one of the least popular, I think, of all the ways that people can address this, just offering higher wages and increasing the prices and sort of reflecting what the cost of things really is. If you do that, one of the benefits is that you don't have any adjustments to your current operations. You're just increasing your prices. You leave the tip system in place. Everything sort of goes on as it was. So it's the simplest to implement operationally. A benefit in that system is if every single employee is already making full minimum wage, then you can spread the tips to the back of the house under current law, not to salaried managers, but certainly the pool can include more people. A significant benefit of retaining tips is that you retain the Social Security tip credit. As many of you know, that's an incredibly valuable offset to your taxes. It's a big chunk of indirect compensation or indirect return on your equity investment, both for yourself and your non-operating partners. So it actually increases the value of it because you no longer have an offset for the wages that you're using to meet tipped minimum wage or meet the full minimum wage. A benefit of this structure is your compensation pool will generally stay the same or even increase if you're able to increase the overall cost of everything and drive up revenue, then obviously the tips would be more. And there's a significant benefit here to not changing the tip model. You don't have to come up with new incentives for your staff to sell. Nobody has to question things. There's a lot of transparency. The existing system, whether or not you like it, does have a ton of worker protections. So if you happen to be pro-worker, then this is not upsetting years and years of adjustments. And there's no uncertainty as to how the wages get put out. You know how to run a tip pool, you know how to spread that out to people. You know that 100% of the wages have to go to them. The cons to this system are myriad. One of them is if there's a forced change in compensation model from tips or from the tipped credit minimum wage to a full minimum wage that phases in over time. We're looking at that certainly in DC as a likely outcome of some of the legislation. If that goes over 5, 6, 7 years, which is typically the structure of these laws in other places, because you sort of divorce the decision from the outcomes, it's going to be a process where you have to raise your prices in lockstep, perhaps with your minimum wage increases. And in fact, most of us have really been doing this over the last several years anyway, as we got to the minimum wage that we have right now. It creates the issue that you have to follow up and you have to pay attention to this constantly. You're sort of constantly moving the needle. So it certainly drags it out for a while. Price increases themselves have a negative in the sense that they're going to change the KPIs of the industry. If the way that you get ahead of paying 15% of your front of house is to increase your revenue to 120% of what it used to be, you're going to have to lower all of your other KPI targets accordingly because you're working off of a bigger revenue pool. Some less sophisticated operators won't be sort of thinking through those adjustments. But if you think about it, if you have a 4% direct operating target and now all of a sudden your baseline is 120% of your old sales, you'd have to drop that to 3.2 as your new target. So you sort of have to adjust each of your marks. A big negative to just a simple price increase is going to have a bigger effect in border restaurants. So anybody who's working near Maryland, working near Virginia, if your prices are 20% higher than the people across the street, just because of a legal border, that's going to make you comparatively non-competitive. We've seen this in some other jurisdictions. Might not affect some of the central business district and some of the major neighborhoods, but certainly if you're operating on those margins, it's going to be much more challenging. And then the obvious con, which we're sort of seeing across the board in the industry right now with other price increases, is simply that price increases reduce demand. There is elasticity of demand for hospitality. As prices go up, then the number of seats you can fill will generally go down. And we're seeing that at a number of places. So I think the industry in general. We've all eliminated most of our pricing slack that sort of existed during COVID to offset labor increases and other things over the last couple of years, and or certainly the last 12 months. So there's not really a ton of room to just jump everything up another 10 or 15 or 20% without that ultimately translating into lower demand. One of the more popular models that we're seeing right now is a service charge. It's the bottom left on this, but the service charge to cover the wage increase while continuing the tipping model. The implementation of this model is one of the more attractive ones. In this option, the business will implement a separately stated service charge of about 10% to offset the labor cost increases to the business. And then you retain tipping in addition to this as part of the compensation model. It's extremely important to note several nuances with this one, and really with any service charge inclusive model where you're using service charge in some fashion. And that's first, that service charges are subject to sales tax in DC. It is an unequivocal point. DC will audit you, DC will crush you for it. And they like to collect this money. It belongs to them legislatively, and they don't really have a ton of wiggle room on you getting out of it. If you're an operator who has not been charging sales tax on service charges, change that immediately. If you don't charge sales taxes on auto gratuity right now, you should consider changing that immediately. Auto gratuity is a service charge for DC purposes. These are big exposure points for a number of restaurants, especially throughout the pandemic, who might have put in a service charge to force their customers to tip adequately in different parts of the pandemic so they could compensate their employees. And there's been a lot of gray area in terms of people just doing what they had to do to survive. But certainly moving forward, you need to be aware of these rules. So service charges are taxable, same 10% as anything else. And again, not an arguable point. Other jurisdictions have different laws. So if you have got restaurants in other places like Maryland, for example, where the service charges or auto gratuities are only taxable with 9+ employees, or when a party has 9 or more guests, you need to make sure that you're just aware of each of the local jurisdictional laws on that. Virginia has its own. Each place in Virginia actually has their own meals taxes, things of that nature. So just work with your CPA or somebody like us to make sure that you're on top of it. It's important to note that service charges are completely separate from tips. They cannot and should not be combined into a tip pool. If you are using a service charge now or have been, your compensation for this, they just aren't part of a tip pool. They can't be paid to people as tips. They don't count against the tip minimum wage requirement. So in a pre-tip minimum wage removal kind of world, if you're using a service charge model, your payroll should be looking like you're paying at least $16.10 anyway, and then you might have different ways of paying out the service charge, but you certainly can't have a service charge and then pay $5.35 an hour and call it tips. That's going to open you up to a lot of liability, and you want to make sure that you're not doing that right now. You also want to make sure that if you're doing service charges and you're doing a tip pool, that you don't combine those funds. They're completely separate things. Auto gratuity and tips are not the same thing, cannot be combined and paid out as tips. These are all common mistakes in the industry and certainly open up a lot of different people to liability for running them wrong. Messaging matters with this. So you should explain the service charge and explain that it is separate and distinct from tips. That's something that you want to work with your CPA and or your attorneys with. Make sure your messaging is correct. Plus it gives you a guest messaging opportunity. And then the other nuance here is to recognize that the difference here is that service charges belong to the business. They are just extra revenue. They don't belong to employees. So unlike tips, you can collect a service charge and end up paying out a portion of that. If you have tips, then you need to pay out almost all of it. The only kind of holdbacks that you can have are credit card processing fees, things of that nature. In this model, the service charge to cover the wage increase piece and continuing the tipping. Pros of this are that you don't really have an adjustment to your operations. What you're doing is simply adding a service charge to offset your increase from the $5 to the $16. You're explaining it to your guests, and that sort of is like one pool that you're doing. Your tip system can stay in place. The service charge you can internally track actually as a contra wage account. So those of you with more sophisticated accounting systems can use that, and you would have this 15% labor cost and then a net from the service charge. You can still keep your KPIs the same. You do have to recognize, however, that the service charge itself is additional revenue. So it's going to be subject to a number of different things, including percentage rent. A pro of this system is that with any system where you have everybody making at least minimum wage without any tip credits in place, the tips under current law can usually go into a tip pool that can be spread to different parts of the house than they can be right now. You'd have to stay apprised of current law for all of that, and those things kind of move a lot. But right now, it allows you to sort of spread stuff out a little bit. You retain the Social Security tip credit, so having tips does continue to drive that for you. And then another major pro is that you still have tips, right? So guests who like to reward servers for good work, you know, and the natural incentive of tips to drive sales, they remain in effect in this system. Cons of it, again, anything where we have an implementation of a forced change to the compensation models that eases in over time, it's going to be difficult. You might not go all the way in. A con would be if you're someone who runs a restaurant with a service charge right now to offset benefits. I do that at my restaurants. It does make the messaging of it harder. You'd have one service charge potentially to offset legislative increases. You have another one maybe to pay for benefits. You start to, you know, nickel and dime your guests, and they don't necessarily like that. Any service charge that's added in is a price increase. So you still have the comparable issues across the borders. You still have the fact that you're going to reduce demand by increasing price. And so that's still a thing. And then the other complexity of this one is, again, service charges, maintaining your compliance with all laws, making sure that you pay in your sales tax properly, that you're doing everything correct. It's a little bit more difficult than some of the other systems. Third common model that people are changing to, this is actually one of the most difficult ones, is a service charge to replace the tips. You get rid of tipping as your primary form of compensation. You charge a service charge and you go to a flat rate pay to the, particularly to the front of house. In these two models on the right-hand side, the flat rate pay to the front of house could be the same thing for the back of house. Some of these service charges can be split out. We'll talk about that. So the implementation of this model is a lot more difficult. It requires really careful consideration of your compensation levels to avoid commitments that are that would bankrupt a restaurant. The calculation that you'd have to do depends on whether or not you're going to try to spread your service charge across both the front and back of house. But it does get really complicated. What you're trying to do is first, you have to compute the expected average service charge amount off of your sales. So first, you would have to understand what your sales are expected to be. Second, you'd have to have the service charge amount itself. So let's use my $100,000 example. We'd expect our service charge to be $20,000, right? That's your service charge budget, basically. Then you have to add in the targeted base wage that you were going to spend in the pre-credit world, or in the existing world. So front of house under the model as it stands right now, you expect to spend $5,000 out of pocket for the front of house, and then you have your $20,000 of tips, right? Now you have $20,000 of service charge. You still have that $5,000 budget. You have to ID third if you're going to include back of house with the front of house in this model. Where we're seeing that most is anybody who's trying to make these changes early, primarily for purposes of reducing, say, pay disparity between front of house and back of house. In that example, you'd have to add in all of your back of house hourly target as well. So we'd have, for my example, $20,000 of service charge, $5,000 of front of house, $17,000 in back of house, and then you'd have a budget of $42,000 total. And then fourth step in this is, once you know what you're going to add together and who's going to get compensated, you have to do a little bit of a chicken and an egg situation here, where you either decide the number of hours first that you're going to put in, or you decide compensation first and then back into the other one. So a simple example of this, let's just say it was front of house only. you'd have $20,000 of service charges. You'd have $5,000 of wages you were going to spend out of pocket. So you have 25 grand to work with. You want to pay every one of your front of house workers $25 an hour, you could schedule 1,000 hours, right? If you want to pay everybody $50 an hour, you could only schedule 500 hours. You can come up with a million different permutations of this and sort of combinations. And a lot of the complexity here comes into, are you going to have different pay rates for people in this kind of model, which typically you would. You might have captains, you might not have captains, you might have servers, bartenders, leads, support staff, all of that kind of stuff, right? So you really have to decide it. And the general main takeaway here is that your labor scheduling process under this model becomes of existential importance to the business, right? So where you can make a mistake in the current model and you might have accidentally spent an extra $5.35 in a model where you're committing to paying $50 an hour to your bartenders, missing by an hour is now 10 times the mistake, right? It's a $50 mistake instead of a $5 mistake, which obviously makes this incredibly important to manage. The pro to this, service charges, as we just discussed, are not tips. They're owned by the business. They're just extra revenue, and they can be allocated to cover whatever you want. So you can use it to cover the back of house and the front of house. You can start to look at reducing pay gap disparity between the two. The service charge can be tracked internally as a contra wage account. So if all you're doing is taking it and adding a 20% service charge and taking away your tips, then your KPIs can be the same. It's relatively simple to implement and message to guests. Operationally, all you do is take away the tip line and add a 20% service charge or whatever your number is. A number of people are doing the service charge and leaving the tip on top of it, which then creates a pool that they can spread however they want to, a little bit of both. But obviously, in real life experience, when you do that, your tip percentage on top drops to somewhere between 5 and 8% in the experience that we've seen so far. Service charge itself usually tends to be a little bit more than 20, maybe 22, 24 at the most so far in implementations. The overall price to the guests in this model can remain effectively the same. It's just a service charge in lieu of tips. If you put tips on top of it, you leave some pressure for the guests to add more, and that drives prices up. But at least it's the tip line is an optional piece of it, so it's not a forced increase in price. Major cons to this, however, this is a full reworking of the restaurant model. In a lot of restaurants and bars, especially anywhere decent in terms of like a full service sit down in DC in particular, your bartenders and front of house staff are averaging often in a lot of the higher ticket places somewhere between $40 and $60 an hour. Even in more like everyday kind of restaurants, you're talking about 35, pretty easy, 35 to 40 for a lot of your service staff. So in many of these circumstances, it's going to be pretty difficult for someone operationally to swallow the amount of money that their staff are actually making on a nominal level. If you think about practical concerns, you're asking your managers to pay their subordinate staff a number that's typically more than they're actually making. We all know that that's actually inside of the industry anyway, but it just comes across a little differently when you're actually processing payroll with a larger number. If the service charges are being used to justify increases to the back of house, it's one pool of money, right? So if the back of house goes up, then the front of house has to go down. The natural result of that is clearly a retention issue. If you're paying $30 an hour and feel generous about it, but the restaurant down the street is paying 45 and using tips, you can imagine how difficult it is to attract and retain great service staff in that sort of environment. Seasonality is a huge issue, but in general, the big con to this model is that very few operators, at least that I've seen, have the true discipline to calculate and execute on the model and sort of be honest with themselves about what their own revenues are going to be. It's difficult enough to predict what your revenue is going to be. It's really, really, really difficult for that to be made into an existential threat to your business. In our experience, a number of the folks who have sort of been early adopters of these models have been less than successful, especially if their compensation models are driven maybe more altruistically. It requires like a razor's really brutal attention to what you can afford and what you can't afford. And that's, like I said, because making, an hour mistake, if you're paying people $50 an hour, is 10 times the mistake as it would be if you're paying them $5 an hour. So if you're going to adopt the flat rate model, it's something where you have to hold yourself super, super accountable and probably change up your scheduling habits across the board. It's really difficult otherwise. The other big problem with the flat rate model is that there are no sales incentives. So what we've seen in practice is when you remove the sales incentives from the team, there's a tendency for revenue to follow that. There's no real reason to push that extra bottle of bottle of wine or whatever it happens to be. So a number of the businesses who have tried to implement this early have had to deal with the challenge of then reinstituting some sales incentive programs that are naturally built into tipping. The last couple of cons on this in particular are to keep in mind that when you use service charge or when you pay straight pay, your back of house, you pay workers' comp on all of the wages right now. If you have a front of house tipped model where you pay $5.35 and the tipped employee is actually making, say, $40 an hour, that whole $35 of tips that they've received, you don't pay workers' comp on. So this change would take your wages and make them all subject, if there are no tips, make all non-tipped wages, especially the service ones, subject to workers' comp, which would be on just a baseline, a 60% increase in workers' comp. It's probably a whole lot more than that. And if you weren't prescient enough when negotiating your service or your rent to exclude service charges from and other forms of like auto gratuity and things of that nature from percentage rent deals, a number of restaurants, especially with older leases in the city, are probably subject in a service charge model to percentage rent being collected on the service charge itself. I'm not sure it's necessarily something that's right in front of all the commercial landlords in the city right now, but especially if there's a mass forcing of the industry to switch to a service charge model, it's hard to imagine most of them are going to be willing to give up what they've already agreed to, which is percentage rent on all of your revenue, including service charges. Doesn't mean you can't renegotiate with them, but it certainly means that the default is likely that your rent's going to go up. And then the final version of service charge, sort of common alternate compensation models that we're seeing so far, would be a service charge to replace the tips, and then using variable rate pay in lieu of a much higher flat rate pay. So implementation of this model is a little bit difficult, but it does maintain some of the positive aspects of a tipped system, and it does reduce the likelihood that you'll drive yourself into bankruptcy due to poor scheduling habits. What you would do here is you move all of your staff all the way up to full minimum wage. As you charge a service charge, because you've taken away tips as the primary mechanism for compensation, you add that up on a period basis as a service charge budget effectively. Whether you do this daily, you do it pay period by pay period, week by week, it doesn't really matter. You add that service charge up as a sort of like your budget that you can spend. Then you can deduct from your budget because, again, the service charge belongs to you. So you're deciding how much to give out to the staff. Generally, you would take out of that budget whatever you've sort of agreed to in terms of hard labor increases. So that extra $10 an hour that you're guaranteeing the front of house staff, you sort of take that in aggregate out of the service charge pool to make yourself whole. And the rest of it is left over to do whatever you want to with it. Some operators keep a little bit of it for their risk. Others that we're seeing pay out 100% of it. So in a super simple example of this, using my platonic restaurant, service charge budget is the 20 grand to service charge that you collect. Your front of house base wage went up from 5 to 10. So you take 10 grand out of that $20,000 service charge budget. And then the leftover 10 grand becomes a pool that you can use to pay bonuses to whoever you want to, commission, bonuses, whatever you want to call it. In the pros to this are, again, service charges aren't tips, so you can do what you want to with them. It belongs to you. You get the benefit of telling everybody, and the marketing thing sort of that you pay minimum wage at least to every single person. You can keep your KPIs depending on how sophisticated your accountants are. It's relatively simple to implement and message to guests in the sense that, hey, we pay minimum wage to everybody. The service charge allows us to do that. And 100% of the service charge is going either to offset the minimum wage obligations and or to add additional compensation to the staff. You sort of have to work with your attorneys and your CPAs to make sure that you're messaging it correctly and legally. The overall price to the guests in this model would stay exactly the same, right? You're adding a 20% service charge, you're sort of spreading it out in different ways. And then you can retain to a certain extent some of the benefits that are inherent in a tipped system. This effectively becomes a commission pool, right? Because you $20,000 that you can spread out. You're making yourself whole with part of it, and then the extra money you're going to spread out maybe on a point system or whatever else. You can certainly leave your sales incentives the same, and everybody could end up exactly the same, or you can spread some to the back of house. A major pro of this version is that errors scheduling at $16 minimum wage are a lot less impactful to you as a business than errors scheduling at $30, $40, $50 an hour. You just pay everybody minimum wage, make yourself whole, and then you move on. The major cons to this system are it's complicated in the sense that you need to every week or every period you have to do computations of exactly what this bonus pool, if you will, looks like, the service charge excess pool. You still, if you're trying to separate or bring the front of house and back of house compensation together, you've got the same problems as in every version of this model. If the pool stays the same and you're spreading it out to different people, it's going to naturally mean somebody has to pay for it. This model is designed to make sure it's not you as an operator, but you'll have retention issues if you drive front of house wages down too much. You still have the same seasonality issues. You still have the same scheduling issues. These are all far more important in a model that is sort of like this than it is in the tipped model. So you can afford to be slightly more sloppy, but you can't be nearly as sloppy as you can, at least in the normal tipped version. And then you still have the workers' comp issue, right? All of your compensation will be charged with workers' comp. So your workers' comp is going to go up significantly. You still have a percentage rent issue. If you haven't negotiated that out, that's a big problem. And then the biggest one here is if you're doing a service charge to replace the tips and you're doing variable rate pay, which is, sort of keeping all these systems in effect, and you're paying either bonuses or sort of commissions to people. The big issue is that there are extremely complicated overtime calculations here, where you have to come up with a different overtime rate per person, effectively, and per payroll. Overtime in this system should be basically avoided at all costs to keep your sanity. I'm not aware of any payroll systems that naturally do this stuff for you. I'm not aware of third-party software that will do it for you. CPAs want nothing to do with it. Lawyers want nothing to do with it. These are very complicated calculations, and Joy is actually going to show you one in a minute, that you would have to do on a person-by-person, payroll-by-payroll basis. So if you choose to do one of these models, you really need to stay, or this model in particular, you'd have to stay away from overtime as much as humanly possible, just to keep yourself from the crazy amount of calculations that you'd have to do. Happy to, at the end of this, I'll be taking questions with the rest of the team here, and then my contact information obviously is right here, and we'd love to work with anybody on this kind of stuff. So I'll let Joy take it from here.
Thanks so much, Matt. All right, so I'm Joy Einstein. I'm a partner in Shulman Rogers Labor and Employment Law Group. We're a firm of about 100 attorneys located in Potomac, Maryland. We do all kinds of law, but I focus on everything legal related to restaurants. So I litigate wage and hour cases. I litigate discrimination and harassment cases. I handle EEOC charges. I do trainings. I do policies. So anything that restaurants could need, I do it. But I'm going to try to limit myself here today to a couple of key issues about these different payment models. So, Julia, I think you're going to have to advance the slide for me. So, talking about the different models that Matt outlined, considerations if you're going to move to a service charge. First, what you call it is very, very important. And this is tricky because the Fair Labor Standards Act, which generally governs how restaurants have to pay their people, doesn't ever define a tip or a surcharge. So what we have to turn to are the implementing regulations to try to get a clue as to what is a tip versus what is a surcharge. So the implementing regs say that a tip is a gift or gratuity given in recognition of some service performed for them. So whether it's a tip and the amount given should be determined by the customer. So we know that the inverse of that has to be true for a service charge. In order for something to truly be a service charge, it has to be compulsory, both as to whether it has to be given and the amount of it. So you have to be extremely careful when you're crafting your menus or your receipts that you're calling things what they are. So we've seen a lot of cases, for example, where restaurants will call something an automatic gratuity, and Matt used the term automatic gratuity in his presentation. But for purposes of the FLSA says a gratuity is the same thing as a tip. So I don't want to see on anybody's menus, anybody's receipts that you're calling something an automatic gratuity if what you really mean to charge is a surcharge. So, what we see are certain sources of liability. One, attorneys generals are generally supposed to, protect the public, making sure that customers know that, what they're giving money for is what they're really giving money for. So, if you call something by the wrong name, it's possible that an AG somewhere out there will determine, we need to look into this. Customers aren't being adequately informed that what you've called something is not actually going to servers. It's being used to pay other costs. And then there's also the potential for wage and hour lawsuits if what you mean to be a service charge, you call a tip or an automatic gratuity or some other kind of creative name. So, what we see out there is that there are plaintiffs' firms who search for these things and they'll say, you called something an automatic gratuity. And so the customer thought that all of that money was going to be paid over to the servers, and it wasn't. And so tips are always the property of the servers. And so now all of that money that you thought was a surcharge that the business owned, it now has to all be paid over to the servers, plus treble damages, plus attorney's fees, because under the wage and hour statutes, that's generally what plaintiffs' firms can demand. And your liability can go back for 3 years, and your servers and bartenders can form a class or collective action to try to request those monies. So you can see how the liabilities ramp up incredibly, incredibly quickly. If all of your servers and bartenders for the past 3 years all got together and claimed all of those monies that you gave us in alleged service charges were actually supposed to be given to us anyways because they're tips and we own them, you can see how that would be a business ending litigation pretty quickly. You also need to be sure that you're carrying over your naming convention on everything. So what we have seen is that restaurants will make an attempt to name things correctly. So they'll say, for example, on the menu, we impose a service charge of 20%. It's to cover X, Y, and Z costs. But then when they go on to, print the receipt, the receipt will have an item for automatic gratuity. And courts have found that if you have confusing nomenclature, so you say one thing on the menu and you say one thing on the bill, that's enough to have a court determine that it's not actually a service charge. So you need to be careful that you're carrying over the name that you use throughout all of your documents. Best practice is to also inform customers either on the menu or some kind of table tent or somewhere what exactly the service charge is being used to cover. Right now, there's no law in place in any of the jurisdictions in the DMV which require you to break down for customers what the service charge is being used to cover. But sort of looking prospectively, I could definitely see an attorney general or somebody out there saying that, it's unclear what the service charge is being used to cover, and therefore it creates some kind of obscurity and customers don't really know what it's going towards. So I think a best practice would be for you to specifically spell out what it's being used to cover. And then another key component of service charges is that they have to be compulsory. So in the industry, a lot of restaurants will comp a meal if service is bad or something goes wrong or whatever. Out of an abundance of caution, I would not comp the service charge, because the point of a service charge is it's not the same thing as a tip. It's not being used to compensate for superior service. So I would say if you have to comp, you can comp the food, but do not comp the service charge. Again, that's just an abundance of caution. And then what we've also seen is that some restaurants have not properly vetted their software. So again, service charges have to be compulsory, which means customers cannot elect whether to give them or not. But sometimes the tech doesn't actually keep up with what you're implementing. So we've had a couple of oopsies out there where restaurants think that customers are not able to change the service charge amount, but in actuality, when you go onto the app, they can change the service charge amount. And we've seen plaintiffs' firms argue that that makes it a tip. So be very careful to vet your technology before you change to a service charge model. Julie, if you could advance on to the next slide. And I think I just covered this already. I talked about the liability. Stakes are very, very high, because if you accidentally call something by the wrong name and a court determines, oh, those were actually tips, then you haven't paid your employees the minimum wage and you can be subject to treble damages plus attorney's fees. So next slide. Also considerations if you're moving to a service charge. Matt talked about this, so I'm not going to harp on it too much. But service charges should go through your POS system, not directly to employees. And that's because employees do not own the service charges. They're the property of the business. And I also just did want to note, we're talking about service charges as if it's a model to pay employee wages, but strictly speaking, a service charge is not a means of paying employee wages. A service charge can be used for anything. It's not just for wages. It's not a wage payment model. We're sort of blurring the terminology for purposes of this presentation, but a service charge is just extra money coming into the restaurant that you own, that's part of your gross receipts, and you can use it for anything, not just for wages. So just want everyone to keep that in the back of their mind. Service charge does not equal wage payment. Service charge equals money that you can use for anything. Other considerations of moving to a service charge: to be mindful of state and local laws. Right now, we don't really have anything to be concerned about. I think you all know you're sort of regulated to death when it comes to the tip credit and tip pooling. Like, there's so many different things that restaurants have to comply with. That doesn't really exist right now for service charges, but you best believe that if a lot of people start moving to service charges, more regulations will come. And that's what we've seen in other states where they do have more restaurants using the service charge model. So for example, in Washington state, none of the service charge can be used to pay employee wages unless it's, line item identified what portion of any service charge is going to go towards employee wages. And if you don't delineate it very clearly and specifically designate it, then it cannot be used to pay employee wages. So I wouldn't be surprised if, a few years down the line, we see similar legislation like that around service charges, just to make things more complicated for operators. So you always want to be paying attention, reading your emails from this organization, seeing, what's happening with service charge. So next slide, please, Julie. All right, customers may complain. So, we see a ton of negative feedback when restaurants move to a service charge model. And, that's really just because customers are used to a tipping framework. Like, they want to have a say in how much their server is rewarded for their service. And when you change that model that everyone's used to, there's always pushback. So I think, it's not really my place, and it's beyond the scope of this presentation for me to tell you what your PR plan should be to deal with a change to the service charge model. But I think, the point is you need to have carefully thought out your PR plan for how you're going to deal with this. And I think, being upfront, saying what the service charge is for, telling customers that the law has changed such that, reliance on the tip credit is, no longer viable. And so, just being prepared for how to deal with it. And not only for your customers, but also for your servers, because servers also have gotten used to being rewarded for their efforts. Certainly career servers are used to bringing in a certain amount of tips each night. And so they need to be really proactively educated on how and why the service charge is going to benefit them. And if anybody wants to write in the chat function, sort of wanted to kind of like crowdsource how other restaurants have dealt with negative customer blowback when moving to a service charge or even like a surcharge model. So if anybody has good feedback for your other operators on how to message it, I would be happy to receive it. So next slide, please, Julie. Considerations if moving to a service charge plus tips model. So if you don't want to go straight service charge and you want to have service charge plus tips, at least for a period of time, here are the things you need to think about. Laws relating to the tip credit and everything are still going to apply, assuming that you can still take this tip credit at least for a period of time. And I would like to mention, even if I-82 passes, there will probably be a period of ramp up. So like what we're envisioning is that it'll say, the tip credit is no longer going to be viable starting in 2028, let's say. But until then, you need to pay a baseline wage of $8, and the next year you need to pay a base minimum wage of $10, and the next year it's $12. And so it'll be a slow ramp up period during which you can still take the tip credit. And so restaurants might say, okay, I'm going to do a hybrid model of service charge plus tips during that time, during that intermediate time period, which is fine. But the biggest drawback to that, I think, is that you still have to abide by the myriad of regulations that bog operators down related to the tip pool and the tip credit. Hopefully everybody out there knows you have to give very specific tip credit notices to employees if you're going to be taking the tip credit. And there's specific language in the FLSA and in different local laws that you have to hit on in your tip credit notice. And then if you're administering a tip pool, there's certain language you need to tell employees about the tip pool, and not to mention the headaches of administering the tip pool. You would still have to abide by the 80-20 rule, which we've given previous seminars on how complicated the new 80-20 rule is and how difficult it is to abide by. But again, since you're still accepting tips on top of the service charge and still taking the tip credit, you would still need to abide by it. And you would also still need to abide by the DC Tipped Workers Fairness Amendment Act, which it has it's sexual harassment training requirements, it's sexual harassment training policies, posting requirements, training for managers on wage and hours, certified payrolls, like a whole bunch of stuff that you would still need to comply with. Whereas a straight service charge model, all of that goes away because all of these things hit on when you're paying by the tip credit, which you wouldn't be anymore. So next slide, please, Julie. So to be a tipped employee, employees customarily have to make $30 a month in tips. And so I don't want to spend too much time hitting on this because $30 is a very, very low threshold. But, what we've seen some operators do in response to rising minimum wages, or in response to the fact that the tip credit might not exist anymore, they've severely, severely slashed the number of shifts people are working. So let's say you have a college student who's only going to be working for you one weekend per month. That person still has to make, on average, at least $30 a month in tips to be considered a tipped employee under the FLSA. So while this doesn't come up often, I just wanted to flag it for you because, there could be an occasion where one of your workers is not making the $30 a month to even be considered a tipped employee, and then you would be violating the FLSA. Another key point that I want to hit on here when you're moving to this hybrid model, which operators do wrong all the time. Tips received in excess of the tip credit don't have to be factored in each week for purposes of calculating overtime. So your overtime calculations, using most of your alts models, are fairly easy. You know what the overtime rate should be, and you just multiply that by the number of hours of overtime worked. It's different under a hybrid model though, because your service charges do have to be factored in for purposes of the overtime calculations. So your overtime calculations are now going to need to be done on a weekly basis for each individual server. So if we could advance to the next slide, Julie. I have a sample calculation here so that you can see just how sort of confusing it can be. And I'm using the federal minimum wage of $7.25 per hour. I know you all are in different jurisdictions, so that's not the minimum wage that a lot of you all are subject to, but this is just for purposes of demonstration. So you can see here that you would need to, you calculate the number of base hours that they work at their regular rate, but then service charges have to be added on top of that. And then you divide by the number of hours worked that week to get their regular rate of pay. And then overtime is sort of like the half of their regular rate times the number of overtime hours they worked. So it's not a difficult computation, but it has to be made for each individual server for each individual week, based on each individual server's number of overtime hours worked. And, there are payroll providers that can help you do this and set this up, but it does, potentially, make running payroll each week a lot more difficult for you if you have this blended model. Next slide, please, Julie. So of course, another option is for you to stay where you currently are, and Matt went through sort of the pros and cons of this. And, I can't really advise you whether this is the right choice for you to stay with the current model, but you do need to be able to be nimble enough to make a change if you have to. So, we sort of never know whether tip credit one day is just going to be eliminated and that's it. So I think at the bare minimum, if you are going to stay the course and keep doing what you're doing, you need to have a backup plan. So if everything changes in the blink of an eye, what are you going to do? Are you going to raise prices? Are you going to cut hours? Are you going to cut jobs? You're going to move to a fast casual model? Whatever it is, you need to have a plan in place, because I do think, when we look at the West Coast, which tends to be sort of like a front runner as to what the East Coast is going to do, we do see that this is generally, what's happening. So I do think at some point it's going to come down the pike for us. So you need to have a backup plan. So that's really all I wanted to cover. I want to be mindful that we are at the 4:00 hour, so I didn't want to go on for too long. But if anyone has questions, we're here to receive them.
So before we jump into questions, which I'm going to ask Che to moderate for us, I want to thank our panelists for all of that incredible info. None of this was meant to be scary or daunting, though we realize it could feel scary and daunting with so much before us. I just wanted to reiterate that, RMW here is advocating on your behalf. We are fighting Initiative 82 to the best of our ability, and we'll all see what happens when that election day comes through, and we'll be here with resources if they're needed on the other end. RMW's board, our executive committee, and our allied partners, we're definitely looking at ways in which some of the things Matt and Joy talked about in terms of your percentage rent, in terms of sales taxes on service charges, and the messaging to consumers, how we can be helpful in all of those areas if 82 were to pass, so that we are prepared on the other end. Like I said, we are fighting this initiative. We have resources for operators and tipped employees. We have an operator Zoom this Wednesday, October 26th at 2 p.m. If you haven't joined a previous one and you feel like you need an update on where we are in the campaign, please plan to join that, and you can get the details from Che. And I'll turn it over to Che to help with some of our questions that I see popping into the question box.
Thank you, Julie. And please enter your questions in either the Q&A or the chat box. And I'll look to Julie so we need to wrap it up. Any unanswered questions will follow up with my email written answer. First question is for Joy. And the question is, if a large party auto gratuity is given to the server, is it okay to call it that on our menus and receipts?
So all of the auto gratuity is being given to the server. So it's just like a tip that the server is retaining. In that case, yes, you can call it a gratuity because it's actually just an additional form of tip that is all being given to the server. So yes, I have no problem with that. Just do not call it an auto gratuity if what you really mean is that it's a service charge where all the money is not being retained by that server.
Understood. Our next question is, can you have different service charges for different types of orders, i.e. dine-in versus takeout?
So you can, and I do see a lot of operators doing that. Well, they'll charge a smaller service charge for takeout. I don't know how I feel about that. I mean, I think if you think about it, a service charge is not supposed to be it's not supposed to replace a tip. So it's not supposed to be something that you're giving to a server for good service. So like logically, I'm not really sure why operators would need to make a distinction between dine-in versus takeout. Because then again, I think you're blurring the models where you're making it seem like this is something tacked on for a server's work. So yes, you can do it. I would just pause and think about the wisdom of doing it.
All right. Our next answer our next question, with the mixed model of fee and tip, if you paid the minimum wage and not take the tip credit, do you still have to comply?
The mixed model of fee and tip, and you pay the minimum wage. So if you're paying the minimum wage, so you're not taking the tip credit, then the laws that specifically relate to tip credit in DC would no longer apply to you. I think that answers the question.
Our next question, does overtime apply to service charges if you pay full minimum wage?
Yes. So the rules about paying employees are sort of like any non-discretionary pay that an employee gets needs to be factored into their regular rate of pay, and a service charge would be non-discretionary pay that goes to an employee. So that still needs to be factored in.
Got it. And that was another question after that about kind of calculating service charges into overtime calculations. Can you tell us more about what West Coast operators are doing?
I think I'm going to throw this one to Matt because I think Matt does more business on the West Coast than I do.
Yeah, sure. In our experience, the West Coast, the full implementation of this has a couple different outcomes. One, famously, West Coast restaurants don't make money. So, as most of us know from friends in LA, they're not generally highly profitable. You find a lot more hotel restaurants out there, a lot more venture-backed restaurants that might not have the same obligations to turn a reasonable profit that we have in most of the East Coast still. So some of them operate sort of in this model, and it just shows up on the bottom line a little differently, where they don't have the bottom line pressures to the extent that they're working in those cities under these rules, and they are under those same incentives i.e. to turn a profit. What you generally find is a change, like a pretty dramatic change in the service model and the number of hours worked, and the two of them feed into each other. So go to like Portland or whatever, and you're going to find a lot more casual types of service rather than full service the way that you would find in New York City and DC, that kind of stuff. There's going to be a lot of like running food to the tables, and sort of the gist of it is you have to cut staff if you're paying them a whole lot more to make the numbers work. Their prices are higher than ours, but not extravagantly so. So they basically drop, generally speaking, a lot of the full service team and make it more about running stuff out there. So you'll find a much more casual type of service environment.
And if it's all right, we'll have time for one more question. I know we're over time and we appreciate everybody staying. This last question, just to clarify, the laws relating to tipped employees will only apply if you're still taking a tip credit. So if you're paying everyone minimum wage, but still collect tips, are there any rules around those tips, or can you split them how you would like?
You can split them how you would like. So we have a federal law now which says that if you're paying everybody the minimum wage, so you're not taking the tip credit, anybody you want can participate in the tip pool, even back of house people. So you have a lot more flexibility there.
All right, and I'll hand it back to you, Julie.
Thanks. I think we're at 4:09. If we do have some more questions that come in, I think we can go till 4:15 here. But I also wanted to mention that we have Kathy Ogilvie here, who didn't present slides because we pulled her and her team into so much of the discussion of what we should cover in this webinar. But if you have payroll specific questions, Kathy and her team are available now or after this webinar to definitely help you with those.
Thank you, Julie. Yes, we have a division dedicated to supporting the hospitality industry and have some real seasoned experts on board that would be happy to address any questions.
For our panelists, are you fine with us sharing your contact info, your email addresses here on the screen?
Yeah, that'd be great.
Of course.
Thank you, Julie.
We can send this around to attendees here as well. This webinar will also be on demand. So if you want to watch again or share with a colleague, please do. Che, do we have any more questions in the question box?
Take a quick look here. All right. What is not clear is when places have to begin. Let me ask this one real quick, and we may have one more after. Follow up on mixed model. To clarify, if you charge a service fee, allow additional tip, as part of doing this, you pay a higher hourly wage, at least minimum wage. You do not need to comply with all of the FSLA regs. Is that right or wrong? And I can reread that.
Let's see. If you charge a service fee so that you're paying at least the hourly minimum wage, I mean, it's a little bit of a mixed bag. I mean, there are other parts of the FLSA that, yes, you still have to comply with. The FLSA is like a broad and very extensive statute. But if you are paying at least the minimum wage, some of the tip credit regulations no longer apply to you because you're not taking the tip credit anymore. So like, you know, there's like this general rule that back of the house can participate in your tip pool. Only people who are, you know, customer facing can take tips. Now that would no longer apply to you because you're not taking the tip credit. You're paying a a flat hourly wage that meets your minimum wage requirements. So tips are just sort of like on top of that, and anybody can participate in them.
Very good. And I'll do our last question. And this spills a little into a legislative one, but for the panelists' thoughts. Built-in implementation period. What is not clear is when places would have to begin to raise their wages to comply. Is there any clarity on when this will occur and what legislative processes will have to occur? Also, Congress will have to approve. And it could likely not due to composition of Congress. Any clarity here? Panelists, any thoughts on that?
Ooh, I don't know who the best one is to answer this. Maybe Julie. I don't really do so much of the legislative work, and I haven't been involved in like lobbying around the DC initiative. I think, I mean, I can say a couple of words. I think, in general, the I-82 is going to be on the ballot. So first it would have to be voted in by the DC voters. And then, I mean, Julie can jump in to correct me, but like last time there was a veto, and so it didn't actually go into effect. And then I don't know that there's any congressional, I don't want to say anything wrong, because again, I'm not so into the legislative sphere.
I think we can also circle back to this question to answer this, the person who asked here, but if the question is about timeline, I think our understanding is, the January increase, if 82 were to pass, may not be approved in time to go into effect, but July will. So there is some time in there to figure out if there's any legislative approach to help soften the landing on this. But again, not sure I completely understand what you're looking to get answered.
And that's it for questions, Julie.
Okay, we'll send that question to Andrew Klein, who's our general counsel and our DC legislative consultant. He had hoped to be able to join here, but he's traveling today. So if we have other questions along those lines, again, we'll give that one to him and we'll come back to you. So with that, thank you so much, Matt, Kathy, Joy, Che. All of you took the time out to join us. We hope this was helpful to you. Certainly a lot of really useful info here. Our intention is to do this webinar potentially a few more times to help reach all of the industry audience who want to have their questions answered on this front. And as you consider all that might go into making a change, whether you need to make a change or want to explore a change, there's a lot to be considered. So thanks again. Have a great afternoon. And again, send us your questions by email. If you have a follow-up, you can send them to info@ramw.org.